All right, we are live. Welcome, everyone. Welcome to Inflation, the End Game. I am your host, Bronson Hill, and I am the CEO of Bronson Equity. We do passive multifamily investing. We also do educational events like this. Really excited you took the time to educate yourself. We've got just a phenomenal lineup today. So I'm going to give a brief intro. We're going to jump right into it and talk about what you all want to hear about inflation. So first of all, we have Jason Hartman, who is the CEO of the Empowered Investor. We have Rick Rule joining us, who was with Sprott U.S. Holdings as the president and CEO. It was a large natural resource space and a broker there. And Brian London, who's the owner of Jefferson Financial and the host of the New Orleans Investment Conference. How are you each, gentlemen?
Doing well, thank you.
Doing great, Bronson.
Great. Really great to have you guys. We're going to jump in. We know this topic is super timely. Everybody's curious about inflation. I love talking about inflation. I know each of you do as well. But really, when it comes down to it, we're going to start with Rick. Rick, why don't you talk to us about why are most people unprepared for inflation, and why is it so important that we talk about it right now?
Well, great question, first of all. I think we've lived through probably the 40 most benign years in global history in terms of the economic climate, when inflationary expectations were dampened and then broken in the Volcker years, sort of 80 to 84, despite the fact that we went to very high positive real interest rates and over time diminished inflationary expectations, there was still the expectation of inflation through most of the 1980s. Now, after 40 years of falling interest rates, and 40 years of fairly benign inflation. Benign inflation, by the way, not mostly due to government policy, but rather due to liberalization of world trade and the advance of technology and demographics. There is no expectation of inflation, despite the fact that inflation is real and around us. I would suggest that the second thing is, remember that people's expectation of the future is set by their experience in the immediate past, not the distant past. And the fact that people haven't experienced inflation for 40 years has conditioned them to expect that the future will be as benign as the past. But I would suggest that one other factor has been that the way inflation is measured and the way people react to statistics has changed too. One example of that would be the CPI stated rate of inflation, which has been hedonistically adjusted. I agree that the quality of goods and services today, by and large, is better than the quality of goods and services that existed in the 70s. But I note that when they hedonistically adjust my habitat, there is no unhedonistically adjusted habitat to inhabit. And the idea that they change the statistics in favor of that is odd. The other thing is that when it's opportunistic, they leave out food and fuel. As you can tell by looking at me, I like to eat and I occasionally drive. And the idea that my cost of living doesn't include either eating or transportation is odd to me. But the oddest thing to me, in terms of the public's acceptance of where we are in terms of the cost of living, is that they leave out tax. If I didn't have to pay the tax, I probably wouldn't bitch so much about the index. But the idea that a measure of my cost of living doesn't include federal, state, and local taxes seems to me to be absurd. I'd like to leave your guests, particularly real estate investors, with one anecdotal fact. When I was a young man, I used to have occasion to stay at a hostelry, a hotel, called Motel 6. Some of your listeners will be familiar with that. I stayed there out of need. Not many people these days know that Motel 6 was named Motel 6 because a room at Motel 6 was $6. Not long ago, I passed a Motel 6 in Burlington, Washington, and the sign said Motel 6, $79.95. They chose not to call it Motel 80. But the point of this is simply there's only two reasons why that could be. One could be that a room at Motel 6 is now 12 times the size and has 12 times the appointments than it had when I was a young man. Or the other is that the median used to purchase a room at Motel 6 has declined in value over those years by 95%. I would suggest to you that it's the latter, not the former. the most pernicious part of inflation is what takes place over time.
Right. No, that's a great point. I remember when I was a kid, we stayed at Motel 6, and it wasn't $6 then, but I never knew that that's why it was Motel 6. But it really is interesting how the government works with this CPI, this inflation number, and they do all kinds of tricks with it. I think, Jason, you've actually created a title and a whole phrase and some education around it. Can you talk a little more about the CPI, kind of how you see that working and how it's really not an honest metric?
Yeah. Well, the CPI is a complete scam. I mean, we all know that. They hedonically index things, and there is some logic to that, which Rick alluded to. You can make a case for hedonic indexing, but what if we hedonically indexed inflation from the invention of the electric light bulb? Everything would be free, basically, right? If you hedonically adjust because of that advancement. And what that says, when you do this hedonic indexing, which is one of the three major ways they manipulate the index, the other two are weighting and substitution. Okay, so they substitute things in the basket of goods based on high prices. So they say, if the price of beef goes up, everybody will just switch to chicken, but maybe you don't like chicken, and then they weight things differently. But with a hedonic indexing, that's especially interesting because it basically says that we as people are not entitled to progress. The index is entitled to the progress. Our standard of living should improve constantly with technology. And certainly our phones are getting better and cheaper, but our houses are much more densely packed than ever before. And it is, and we just have all sorts of things. Another thing that really is just completely left out of the index is the fact that we do so much stuff ourselves anymore. I mean, think of the internet. It's a completely self-service environment. Nobody has their gas pumped for them anymore. Even billionaires pump their own gas. It used to be when I was a kid that, when you got gas for 28 cents a gallon or 32 cents a gallon, they would wash your windows, check your oil, fill your fluid for your windshield, fluid. I mean, it's just a completely different world nowadays. Even trendy, cool restaurants, they don't wait on you anymore. You go up to the counter, you place your order, and they might deliver your food to the table if you're lucky, but you still are expected to tip the exact normal amount. So inflation is all around us, and it's easy to see. Let's just hope it doesn't go as far as Zimbabwe.
$100 trillion, exactly. So people are looking right now for places to hedge against inflation. Everybody knows inflation's here. It may not be transitory. Where do we put our resources? And so one place is real estate. That's a lot of what we do. We also have a big passion, or I do personally, for precious metals. And some of my real estate friends are like, "What do you like precious metals? Like, why would you do that? It's not real estate." But Brian, can you talk a little bit about why every investor or every individual should consider owning precious metals and kind of what that looks like?
Yeah, sure. And I have to say, I didn't know we were allowed to bring props, so I would have brought my own Zimbabwe.
You're allowed. If you need to leave the room and go get some gold.
I can't believe I didn't think of that. But yeah, precious metals. To you, the first and primary role of precious metals is as wealth insurance against something that you don't think might happen, like your homeowner's insurance, where you don't really expect your house to catch on fire. Precious metals are insurance against something that you know is going to happen. That is, your underlying currency is going to depreciate and lose purchasing power. Now, it loses purchasing power at different rates. So pundits like to look at gold, for example, and say it is not the best inflation insurance, because if you look at the rate of inflation and you look at the price of gold, it does rise and fall with the rate of inflation. But it's really the wrong measure. That isn't when gold comes into play, and to another extent, silver. Gold really makes up for lost time when people begin to truly worry about the purchasing power, the future purchasing power of their currency. And that's when the price begins to really rise, make up for those periods when it was somewhat quiet and inflation was still chugging along at lower rates. And that begs the question, where are we right now? I think we're about to enter one of those periods where people become more and more concerned, and for good reason, about the health of their currency and its future purchasing power. Because right now, people aren't that worried about inflation, despite having so many reasons to be. One reason why is because if you look at things like the implied inflation rate or the future expectations of inflation in the market, what Wall Street looks at, they look at forward inflation expectations really being somewhat moderate, because they're using the inflation rate as implied by Treasury inflation protected securities, or TIPS. And that leads to a real yield on treasuries of maybe minus 0.9%. So not really that much. You're talking about inflation of around 2% or 2.5% as far as what Wall Street thinks it'll be over the next 3 to 5 years. But back in the 1970s, they didn't have these fancy schmancy TIPS implied inflation rates. They didn't even have TIPS back then. So what did they use to gauge inflation? The CPI. Back then, if you took treasury yields and you subtracted the rate of inflation, you had real yields that were negative 4 to 5%. Nobody talks about that today, because they say, well, real yields are less than negative 1%. But if you deflate yields by the CPI, like we did in the 1970s, then you have negative real yields that are as low, as much negative as they were during the depths of the 1970s, when you had precious metals prices soaring. So I think where we're going through right now is a transition where the market doesn't really appreciate this fact, that what we're going through right now in terms of negative yields is identical to what we had in the 1970s. I think they're going to realize that over the months to come, when they also realize that the Fed is powerless to really normalize monetary policy.
I think that's a common thing that people are seeing, that, a lot of people are saying, hey, gold's kind of stayed where it has, like the last couple of years, hasn't really moved much, maybe come up a bit, but then there's this idea, at least a lot of people in the industry kind of feel that, is this an unloved type of asset right now? And Rick, I heard you recently on an interview, you were talking about uranium being an unloved type of asset. I know it's a little hard to own uranium as an individual, but can you talk a little bit, maybe historically, with your experience of how metals and some natural resources move during times of inflation, or even just other assets, and kind of what sectors do you feel are unloved that might be potential opportunities for investors?
Yeah, I think it's a mistake to lump all natural resources in one sort of investment bucket. It's a broad class of assets, and they have moves that might be very broadly correlated, but not broadly correlated enough for most people to develop an integrated strategy. I've been in the gold business now, I guess, 45 years. And I can tell you that one of the things you learn about a gold bull market is that it's extremely volatile, and it can take a long time to play out. People whose attention spans are shorter, younger investors as an example, or people who haven't been through these bull markets, don't understand that. The first bull market that I was involved in gold ran from 1970 to 1981, 11 years. The second one from 2000 to 2011, coincidentally, 11 years. People say now, Rick, assuming we're 3.5 years into this bull market, have I missed it? Is it over? If past is prologue, no. We're still in the first half. These things are of really substantial duration and substantial dimension. People say the price has gone from 1,000 to 1,800. Have I missed the boat? Well, again, 1970, the price was $35. 1981, it was $850. 2000, it was $256. 2011, what was it, $1,900 and something dollars? So a move from 1,000 to 1,800 is not an extravagant move when viewed against prior bull markets. It's important to know too that bull markets, every bull market, secular bull market that I've seen, has had cyclical declines. Gold being no exception. I think that we've been through a cyclical decline for 12 months. I remember one in 1975 when the gold price had gone from $35 to $200, six-fold move. Everybody was elated. Fed let U.S. interest rates rise. The gold price fell from 200 to 100. In other words, a 50% cyclical decline in a secular bull market shook out a lot of the faithful. And then gold went from 100 to 850 when the Fed lost its nerve. So I would suggest that what you're seeing right now in the precious metals market is precisely a cyclical decline in a secular bull market. No suspicion, Brian talked a lot about the impact of negative real interest rates. No particular mystery that when the yield on the U.S. 10-year Treasury fell from 300 basis points to 60 basis points, that the gold price went from 1,000 to 1,900. When they let the interest rate rise from 60 basis points to 150, the gold price increase moderated and then fell. I don't see, like Brian doesn't see, them having much room to allow positive real interest rates. So I feel good about gold and silver. I feel particularly good about them because they aren't on most people's radar screens. When you talk to a lot of investors, they don't even think about gold. Here's an amazing statistic. Precious metals and precious metals related assets comprise 0.5% of the savings and investment assets of Americans across all asset classes. The 3-decade mean is 1.5%. If precious metals merely reverted to mean against negative real interest rates, debt and deficit, quantitative easing, demand for precious metals and precious metals related securities would triple. That's what I think is going to happen. I don't think that we're going to have this circumstance where, the dollar blows up and, America becomes Venezuela or anything like that. But I think we're going to have reversion to mean. And I think for investors in precious metals, that reversion to mean will be very, very, very pleasant. In terms of other commodity sectors, I continue to like the energy complex. I realize that Biden doesn't like it, and Trudeau doesn't like it, and Merkel didn't like it, and Greta Thunberg doesn't like it. All the big thinkers are lined up against it. But all of us like it. When we all go from our bedroom to the garage and turn the key to the right, we kind of like it if the car starts. When we go to the wall and hit the switch, we want the lights to come on. Oil companies make pretty good money at $60 a barrel, but they're still not making sustaining capital investments, which means supply is going to continue to fall even as demand holds steady. The best performing commodity in the last 12 months, you know what it is? Coal. Greta's favorite, coal. At these prices for seaborne met coal, these are the highest real prices seaborne met coal has ever seen. The big thinkers of the world thought that coal was going to go to the way of sealing wax and buggy whips and stuff like that. This is the most profitable time the coal business has ever seen, never mind the natural gas business. And even the age-old pariah, uranium, has gone from $18 a pound to $50 a pound. Find something that everybody hates. I think if you are an investor in natural resources, that you need to consider the mid-cap gold stocks, companies on average with 10-year reserve life indexes and 20% free cash yields after sustaining capital investment. Or you need to look at oil and gas producers, particularly the big ones, particularly American and Canadian, Greta notwithstanding. I think the uranium stocks are ahead of themselves, frankly. The uranium stocks have gone from completely decimated to uniformly up 300, 400, 500%. Those stocks are certainly ahead of themselves. But I think there's plenty to do in the conventional energy complex. And for the first time in my life, gold stocks are cheap in a circumstance where I believe that gold has to go up.
Right. So, Rick, you bring up a point I think a lot of investors need to take note of is that, there are sectors, and particularly in commodities and natural resources, that are unloved. And, if we start getting a place, let's say we have some sort of single family, I'd love to hear Jason's opinion on this as well, but if we have some sort of decline in some single family home prices or rates going up or other things, and there's high inflation, people start saying, hey, where do I store my money? So metals or natural resources can be a great way to do that. Jason, I wanted to hear from you on your take on how real estate kind of fits into this picture. Is real estate a good inflation hedge? If so, what type of real estate? Any sort of thoughts you have on that?
Yeah, well, I teach the strategy you alluded to earlier called inflation-induced debt destruction, and I've been talking about that for about 17 years. And the whole concept of real estate being an inflation hedge, the way most people think of it, is pretty simple, right? The real estate will outperform the CPI, or the Consumer Price Index, or at least keep up with it. But that's just a minor thing. What really happens is when you use leverage against the property, you use debt. And like we all will agree, you're getting that debt at negative interest rates. So if inflation is, say, 4%, I mean, I think it's 10, maybe 12%, depending on where you live and how you spend. Everybody has their own personal inflation rate. And you're borrowing at 3% for 3 decades fixed, then you're getting paid quite a lot to borrow there. Maybe you're getting paid 7% to borrow the money. Not to mention that you get a tax deduction on the interest, so you're getting paid again there from the government. And not to mention again that if you don't pay your own debt, meaning you delegate the debt obligation to someone called a renter, a tenant, and they pay the debt for you, the returns really do become infinite. So the inflation-induced debt destruction, the way inflation destroys the value of debt, is a very important and meaningful factor for real estate investors. And it works with other assets too. It's just that real estate is a very debt-favored asset class in this country. Lenders like it. Fannie and Freddie, they'll buy those loans. 3-decade fixed-rate loans at negative interest rates that's a pretty amazing vehicle. It really is. And especially when you can outsource that debt obligation to somebody else. And when you look at the purchasing power of gold versus the median price of real estate over the last 5 decades or so, it's pretty interesting. Many of those decades and many of those years, if someone was, say, saving for their first home, they would have been much better off every time they got a paycheck to convert that paycheck to gold and then to save the money in gold. And then when they were ready and they had enough in gold, translate that gold to dollars, exchange it for dollars, and then buy the house, right? They would have been much better off than storing their money for those years leading up to their purchase in dollars, because the dollar just keeps getting debased. And of course, the government has this false narrative about what the real inflation rate is that we've already talked about. But there's just no question in my mind that the macro trend, the long-term trend, is inflation. And knowing that, if we can get a mortgage today, and we can do this multiple times with a whole bunch of properties, and we don't have to make the last payment on that mortgage until 2051. Just really think about that. 30 years. How much inflation will we have in the next 30 years? It's probably going to be pretty significant. So that's it. That's why it's a great hedge.
Yeah, it's a great point, Jason. I think, taking out debt for real estate it's a great time to get long-term fixed debt. And as our friend George Gammon says, the asset is really not the real estate, it's the loan on the real estate, because you get to have it for this great amount of time. Like
arguably, the mortgage is the asset, and the property just rides along with it.
Right. Exactly. So let's shift gears here for a minute, and if you guys feel free to jump in if you have anything to share or anything that we're talking about. I'm just going to keep kind of going around, but I want to hear from each of you on this. But this just came out, I think, this week. Just today, actually, was talking about the Fed looking at tapering, and maybe sooner than they thought, where they're going to reduce the amount of bonds that they're purchasing, and then also maybe potentially increasing, the interest rate, the Fed interest rate. What, Brian, do you have any thoughts on kind of the timing of this, or how this is going to affect investments, or just, I guess, in general, a lot of people are in the stock market, they're in other assets. I know we're all kind of a lot of physical stuff with real estate and metals, so maybe you can touch base on how you see that affecting, different asset classes.
Yeah, today's Fed meeting was really the most dramatic and eagerly awaited since the last Fed meeting. And the one before that, we had this kind of brinksmanship in the markets where they look forward to whatever the Fed's going to say next and lay their bets accordingly, then take the money off the table after the Fed comes out. But it really was today a nothing burger. They were talking about tapering. They've been talking about tapering back QE. And this time they're really serious. They think it's really close soon. The consensus is that the next meeting they'll announce a time frame, and then at some point they'll do it. I don't think they're going to get all the way through whatever taper timeline they announce. Post 2008, we saw that when they tried to normalize rates, we had a taper tantrum, then they went ahead and they got back to it. They were eventually able to taper back asset purchases, and then they actually started on rate hikes at the pace of a quarter point a year. And the market still threw these hissy fits along the way. And eventually they had to turn back and actually stop that and start lowering rates again and actually begin QE well before we had any talk of a pandemic. So this has been something that actually happened of its own accord. They had to back off of their campaign to normalize. We know that things that happened then are happening much more quickly now and to a much greater degree. So I don't know that they're actually going to be able to get to rate hikes. I think they're actually going to have to halt the tapering at some point. If you visualize what they've done, they've blown up this big asset balloon, financial assets, real estate, but primarily equities, to the point over the past 2 decades where the stock market in the U.S. has really become the economy. It used to be that people would say the stock market isn't the economy, but it really is right now. If the stock market goes south, the dominoes start to fall, and we go back into recession or worse. So they built this monster. Now they have to feed it. They have to keep the financial assets elevated and floating on the sea of liquidity. Now, they're constantly to do this. They're constantly purchasing securities every month, 120 billion a month, and that's inflating this balloon. So if you reduce the rate of inflation, what's going to happen to the balloon? It's going to get smaller. So the markets will react to this at some point and will start to contract, and they will throw this hissy fit and tell the Fed, cut it out. We need you to not only continue easy money, but we need ever easier money. So come up with something different, come up with something new programs, expand what you've done before. We're going to go back through that cycle. And I think that the reckoning will come as the markets start to realize that this will happen, as we get some reactions in the markets from tapering, and as the Fed is once again exposed as being essentially powerless to do anything but keep the money flowing and at ever greater rates.
Absolutely. Yeah. Rick, what are your thoughts on this topic? You have a lot of thoughts.
I think Brian covered it fairly well. I mean, the economy has too much liquidity in it right now. And I think the Fed would do well to reduce some of the liquidity in the economy, however they choose to do it. It wouldn't surprise me to see them attempt to taper. It wouldn't surprise me to see interest rates rise in the near term. I have 2 comments on that. The first thing is that interest rates are so anomalously low in historic terms that ultimately a moderate rise in interest rate, while it would have an immediate impact, wouldn't have much of a long-term impact. Many people listening to the show might have attention spans that are so short that they'll be terrified. Increasingly, people who make their decisions on cell phones seem to have a problem with an investment that might go through a long weekend. And the problem there isn't the Fed, but rather it's the investor. So if you look back in a historic sense, as an example, and Brian covered this fairly well, historically, the U.S. 10-year Treasury has had a positive yield to the CPI stated rate of inflation. If the CPI stated rate of inflation is 5.5%, you had a 100 basis point positive yield. That means that the U.S. 10-year Treasury would be 6.5. Traditionally, the 30-year fixed rate has been priced at a premium to the 10-year. So think about a 7.5% 30-year fixed. Do you think that the voters or the politicians would stand for normalized conditions? The point of all this is if they tapered a little bit and they raised the yield on the 10-year Treasury from 120 to 210, would it have an immediate impact on the market? Yes. Would it matter much in the 2 to 3 to 5 year time frame? I don't think so at all. It might matter to some individual investors who didn't have a sense of history, but I don't think in terms of the outcome that it would matter a bit. I wanted to jump in a little bit. I'm not an expert on this, although it's been good to me. One of the things that this will be a soft pitch for the real estate guys. One of the things that I think you forgot to mention in terms of real estate and inflation is if you have a circumstance where, first of all, the competition that you face from new builds is constrained by inflation and by inflating fees, municipal fees,
Yep.
and where you can raise your rents a little bit every year for 30 years, but your cost of capital stays fixed.
Right.
The delta between the cost of capital and the return on capital employed over 30 years, I'm old enough now to have experienced this personally, truly spectacular. What's coming out of it, I think, I mean, the thing that really, really benefited me in terms of that delta was that cap rates, with interest rates declined. I don't think that I'm going to get that bonus again. But the truth is, when I was investing passively in multifamily 30, 35 years ago, it never occurred to me that I was going to get a benefit from declining cap rates. I just thought that the delta between my cost of capital and my return on capital employed was going to continue to increase at the same time that people were going to be unable to compete with me because fees and costs would continue to increase. And I think one of the unsung benefits of real estate in inflation is just that. Your rents increase marginally year after year after year, and your cost of capital don't.
Yeah.
Yeah.
It's a pretty circumstance. Believe me, when I look back, with very little effort, it was very good to me.
Absolutely.
I couldn't agree more.
Yeah. No, that's, obviously anybody that does real estate, it's great to hear you've been doing it for 30 to 35 years and passively investing, and you've had those kind of results, and it's awesome. And we feel that, long-term debt on these big properties are phenomenal. I want to shift gears a little bit. We're going to get into questions in a few minutes. The time's going really fast. I want to make sure we kind of handle some of the big questions. But the big question, I think, kind of in the title of this is inflation, the end game. So I guess I'd love to hear, we'll start with Jason, but just how do you see this playing out, in financial policy in the world and assets, just as far as what does the Fed do here now? Do we just simply kind of inflate our way out? Do we have a Paul Volcker kind of character that comes in and just, has the will to just kind of raise interest rates to the sky? What are the kind of the things that you see happening? Some of you kind of alluded to this. Maybe Jason, you could start and we'll kind of work our way around.
I don't see another Paul Volcker. I think America is way too oriented toward instant gratification, and nobody would tolerate a Paul Volcker today, unfortunately, because, in a sense, he really did the right thing by breaking the back of inflation. But the political will to do that nowadays is, I just can't imagine that. So we'll continue to pour gasoline on the fire, in my opinion. And the governments and the central banks, their business plan, all of them around the world, is inflation, but especially the United States, because the U.S., as long as it can hold the reserve currency status, and I believe, given its military, it can do that for quite a long time, whether people like it or not. We've got aircraft carriers and more than anybody. So, I think the business plan is inflation. The government gets the advantage of inflation-induced debt destruction, just like we as individuals do. We have 10% inflation. We owe $1 trillion to China, in an example. Poof, $100 billion of that debt just vanishes. It's magic, right? And so they want inflation. They will create inflation. One of the interesting things, and I'd love to see what everybody thinks of this, but I've had this theory, and I don't know, maybe it's just a nutty theory of mine for many years, that there was some tie-in between 1971 and Nixon taking us off the gold standard, the final vestige going away, and his trip to China. He knew that China had all this cheap labor, and what do you know? About 10 years later, that all started to happen. And now the world has exploited a lot of its cheap labor. Yes, of course, China is really working on Africa and but that's very disjointed. It's much different. So I don't know if we can continue to make things as cheaply as we have. Technology certainly will continue to amaze us, I think. But overall, I just think we are going to see a continued wealth transfer away from the middle class and the upper middle class to the elite class. And the standard of living for many people will unfortunately decline. And I'm sad to say that, but I think that's what's going to happen.
Right. Brian, what are your thoughts? How does this all end?
Well, I think Jason put it perfectly. The thing about inflation is it doesn't hurt the rich. They can escape it, they can benefit, they can profit from it, but it really hurts the lower economic classes from up to middle class, really, because they can't do anything about it. And that's the criminal, the diabolical thing about inflation. And as Rick mentioned early in our talk, nobody today alive really knows how that was. I mean, some of us have experienced it, but it is such a dim memory that even we don't really recognize it or remember how devious and diabolical it is. So there is an end game here. What we've seen is since the early 80s, the 70s, the central bankers got the ability to spend, to monetize debt without repercussions because we severed the tie to gold, between the dollar and gold. But as P.J. O'Rourke said, to paraphrase him, cutting that tie to gold was like giving a bottle of Jack Daniels and the car keys to a teenager. So the central bankers just proceeded to immediately drive the car off the road into the ditch. And that was the 1970s. So they got a little bit more circumspect about it, a little bit more careful. And in every economic slowdown since then, they lowered interest rates, and they were never able to get interest rates back to anything resembling where they were beforehand. That now we've reached, in 2008, we reached the foundation at zero interest rates. We've gotten there again. So where do we go from here? We go through boom bust cycle over and over again, with each bust getting more and more liquidity. At some point, I think the currency loses its credibility. I don't know whether that's this time, next time, the one after that. At some point, I think it does. And what do you do at that point to regain that credibility? You can instantly regain it by attaching the currency to gold or something else. I think gold's the obvious answer at that point. If you do that, that projects to very high prices for gold. As James Rickards says, $10,000 an ounce if you back into by 20%. That may be one end game. I don't think anybody really knows what the end game will be or the precise path to get there. But the one thing I think we can be confident of is that you want to own gold, you want to own silver, you want to own income producing real estate and tangible assets going into what lies ahead. Right.
Rick, what are your thoughts?
Well, interesting question, and I'm sure to get it wrong, but I'll take a shot. I'm a long-term optimist. I look at the challenges that generations before us faced. The Great Depression, World War II. We're not the first people that have had to stare down the plague, but we are going to have to. We are going to have to stare down a plague. I remain amazed at the results of individual initiative in the United States. A group of teenagers takes over a garage in Sunnyvale, and out pops Google. And so long term, I think that we are such creative, such tenacious, such hardworking people that our individual initiative will find a way to fund our collective stupidity. But I think the place that we get to between now and then is going to try all of us. It's one thing dealing with $29 trillion in on-balance sheet obligations at the federal level. Okay, 23 net of the Fed balance sheet. It's entirely a different thing dealing with $120 trillion net present value of off-balance sheet obligations. Your viewers should look at me, age 68, to see the personification of an off-balance sheet liability. Medicare, Medicaid, Social Security, Transportation Trust Fund, Environmental Trust Fund. This is money that's all been spent. When they talk about a trust fund, it's the equivalent of you borrowing a bunch of money from your IRA, going on a drunk and throwing an IOU in there. the money's gone. The obligation remains. So how do we deal with that? My suspicion is that part of it is inflation, like we did in the 70s. We inflate away the net present value of the obligation. The other thing is that younger people can fix this. Partially the problem goes away because we die. Old folks die. And well, it isn't pleasant for me. It might be pleasant for the country. But by statute, government debt really is a transfer of wealth from younger, poorer people to older, richer people. We voted ourselves all these cool benefits, but we forgot to pay for them. So we're stiffing the kids. The kids might want to say, let's look at Social Security for fun. When it was instituted, it sustained you at poverty level after age 65, and the average life expectancy of an American male was 64 years. That wasn't a tough promise to keep. So perhaps, in addition to inflating away some of the net present value, they would raise the eligibility years to 75%. Perhaps they'd index it to inflation. It'll be a tremendous political fight to do that. But I remember Churchill once saying about Americans, they always do the right thing when they've exhausted all the other options. I think we're coming into the period where there's going to have to be a combination of approaches. We're going to have to rely on American creativity and ingenuity. We're going to have to inflate away some of the net present value of obligations. And we're going to have to renounce, informally default on some of the social expenditures that we've all grown so fond of. More importantly, of course, what do your listeners do to defend themselves when clearly nobody else is defending them? I personally think that you have to store some of your wealth for insurance purposes in precious metals. I think speculators should own precious metal securities and other types of resource securities because they're cheap. I think you have to invest in circumstances where the arithmetic is good. It may be multifamily in Florida where they seem to be a little more averse to rent control, and they're kind enough to let people move there, where your rents increase a little bit while construction costs go up, which diminishes the competition, and your cost of capital stays free. I fully suspect at some point in time, it's happened 5 times in my life, that the major equity indexes will fall by 40 or 50% again. I'm not talking about a great reset. That's just the way things happen. When that happens, investing a reasonable amount of money in the best companies in the United States with the view to holding them for 20 years. Yes, they might fall another 20%, but they will certainly be selling for much more 10 years from now and 20 years from now than they do right after a fall. Will be a good thing. And the thing that everybody misses is you have to stay liquid. It's really tough to do when the purchasing power of your cash is declining by 5% compounded. But you have to have cash anyway, because when there's volatility, there's the probability of a liquidity squeeze. And if you come into a 2008 style liquidity squeeze, having the cash gives you the tools and hopefully the courage to take advantage of volatility rather than being taken advantage of. It pains me in some senses to look at a big bank balance, which relative to my needs I have, because I understand what's happening to the purchasing power. But I remember what I was able to do in 2008. I came into 2008 fairly well cashed up. 2009, 2010 were anomalously good years for me because my balance sheet was in shape. Even the old junk bond king, Michael Milken, said, yes, absolutely. Take on high rate debt, but keep yourself some cash on the side so you can service that debt.
Mm-hmm.
I think people absolutely positively, despite the fear of inflation, have to stay liquid. Some of that liquidity, of course, could probably be gold and silver.
I think that's a really great practical tip for everybody, to have some liquidity available, have cash available. And like you said, it's challenging because you're seeing inflation, but having some resources for those, if you get in a liquidity issue or being able to take advantage of that is important. So,
and by the way, having credit available is not the same as having cash. I remember having a very large line with a Canadian chartered bank, and having them call the line, giving me 90 days. And I said, you can't do this. And they said, here's the contract. There's 300 pages. We can find somewhere in there, You know, you have 90 days to straighten this out. Having a credit line is not the same as having cash.
Yeah, and that definitely happened during the Great Recession, as you know. Yeah.
Absolutely.
A lot of people got their HELOCs reined in. Yeah.
So we're getting some questions here now. We're going to shift to do a few questions here at the end. So I'm just going to kind of put this out to the group, and whoever wants to jump in can. But what percentage cash should be? I guess a better question is, what percentage of your investable capital should be liquid, or what percentage should you have in cash of your total net worth? There's a couple ways to put that.
I think that depends on the rest of your balance sheet. And I think it depends on who you are. If you're a businessman and you're operating a business where something like COVID, as an example, might affect you, it's a good thing to have more cash rather than less. It really depends on the nature of the business that you're in. There's no one size fits all answer. Right now, I'm very heavy cash, but that's partially a consequence of liquidating some 30-year-old investments in real estate. And I haven't yet redeployed the money. This isn't tactical, but I think there's a different answer for different people. If you have a heavily leveraged personal balance sheet, you have to have more cash. You have to have the availability to service that debt if your income falters in a bad situation. Similarly, if you're a speculator, if you're a good trader, you need to have a reasonable amount of cash because you stand to profit almost illogically from volatility, which is almost certainly coming.
Yeah, and as Rick had alluded to when he was talking before, that if you are speculating and you're trying to catch those bottoms, you don't need just cash. You also need the courage to go along with it. Cash and courage go hand in hand.
Yeah. And I agree. It depends on your personal financial situation. How high are your expenses? Are you self-employed or not self-employed? All big swings. I can answer the question for the real estate, though. So the cash in relation to real estate, we always say people should have a minimum of 4% of the value of their portfolio in cash, just to service the properties only, not the rest of their lives by any means, or their business. But if they've got a $2 million portfolio, they should have 80 grand earmarked, just set aside for surprises, vacancies, repairs, etc., at the minimum. And maybe they'd want to be more conservative and have 7 or 8%. But remember, of course, as we all know, if you go too high, then that cash value is getting eaten up by inflation. So there's a balance there, obviously.
Absolutely. This is a little bit, this is an interesting question, but this is Edwards asking, if the dollar were to be dethroned, would copper pennies be worth more than the value of the copper content?
They already are.
Yeah, that happened a while ago.
Yeah. I know Kyle Bass did this with nickels, right? He bought like warehouses full of nickels. Are there any like alternative strategies that you guys have seen that besides having warehouses full of stuff and armed guards, or anything you've seen like that that's a little bit out of the box?
I think that nothing so much out of the box, but I think that having precious metals, it's important to have physical metals in your possession or readily accessible. And that readily accessible does not include a safe deposit box in a bank, because one of the things you're insuring against are bank holidays. So how you do that is up to you. Be clever about it. If you want to buy or download one of the free reports available on the internet on how to store precious metals in your home, just realize that every burglar worth his salt has already downloaded that report. So
good point.
Just be careful about it, but make sure you have a decent amount accessible. And you can further insure your wealth by having it in storage facilities and in other countries, et cetera, but don't put all of your eggs in one basket by any means.
Agreed.
I think you're on mute.
Oh,
Bronson.
I think you're muted, Bronson.
I was having a great conversation with myself, so
we could tell.
I hope you were reading my lips. Any fears of crypto replacing cash, or even not just crypto, but I would also add Fed coin or some sort of federal digital currency replacing cash down the road. Is there any concern about that from each of you?
Not from me. The daily volume in crypto, including trading volume, is something like 1 billion too. I have no idea what the daily volume in cash is. Crypto is important to people who own it, but I think the aggregate value of all the crypto in the world is something like 1.2 trillion. And the aggregate value of all savings and investment products, not all currencies, but all savings and investment products worldwide, is $600 trillion. Crypto at present is about as important to the global economy is as a pimple on an elephant's behind. It's just it's a wonderful asset class, but it's an irrelevant asset class on a global basis, just like gold.
I'm actually am worried about it. One of the things that Powell said in his press conference today that I didn't think got much notice, he was asked about central bank digital currencies, and he was kind of preparing the field for it. He said that they're going to come out with a report shortly on it, and he thought that that was an important part of the process. And I think he kind of let that slip at that point. The process, of course, is the PR campaign to convince people that it is good and necessary and helps in transparency and efficiency and makes their lives much better to accept a central bank digital currency. So that will happen, not just in the US, but with every major country out there. They're essentially going to expropriate the cryptos that have been on a private level right now, and I think take a good bit of the use argument for private cryptos from them. I like cryptos. I love the goal to insulate people from government control, however that's possible. But I do think central bank digital currencies are going to be part of this move toward a cashless society. And that end goal is not for your own good. The end goal is enhancing control over your daily life.
Yeah, the COVID crisis has really checked all the boxes for any tyrannical dictators out there, and they can do all sorts of things to control us and surveil us that they really couldn't get away with before. And a central bank digital currency that is part of all of our smartphones could be very scary. I mean, the amount of control they could exert with something like that, they could create inflation or deflation on a daily basis on a whim. They could they could enforce curfews with the currency. Maybe the currency doesn't work during certain hours. Maybe it doesn't work more than a mile from your house. Who knows what? Maybe it doesn't work at certain places. Maybe if they don't like your social score, you can't buy internet access or cell phone with your central bank digital currency. There are all kinds of really scary things that they could control with something like this. And it's coming. It's just a matter of time. I mean, we're going to have a digital dollar of some sort. I mean, that's a foregone conclusion if you ask me. I don't know when, but it's coming.
So that brings us, we'll take time maybe for another question or two, and then we're going to wrap kind of around the top of the hour. But I wanted to ask, a lot of people are wondering this. So we talked about a lot of scenarios here, but we really, with COVID, we've seen a lot of spending. We've seen, stuff move around a little bit, but financially and economically, besides the stock market dipping, March of 2020 for a bit and then recovering, we really haven't seen too much financial financial upheaval or anything. Well, when do you see, the question I guess is, when does it start getting real? When do we start saying, oh wow, inflation is really out of control, or we're really at a desperate spot here as a country and we all feel it?
Starting with me, I guess I don't know. I think we will feel it. Liquidity is a great soporific, and people prefer not to be afraid. So they choose not to be afraid. They choose to avoid the arithmetic around debt deficits and liquidity. But in my experience, the piper always has to be paid. You get out of too much debt either by reducing spending or by defaulting. And the piper has to be paid for the economic damage done to the economy by COVID too. At some point in time, there are diminishing returns from artificially induced liquidity. That arithmetic runs right square into the narrative that's been engendered by 40 years of benign economic climate. People don't want to feel afraid, given their expectations of the future have been set by their experiences in the immediate past. You buy the dips, you exercise the Fed put, and there's enough liquidity that the world goes on as normal. I guess, was it Hemingway? They asked somebody how you go bankrupt. He said it first very slowly and then later very rapidly. And I think the circumstance that confronts us in terms of paying the piper is very much like that. The fear will build very, very, very slowly because our experience is 40 years of benign existence. But if concerns begin to mount, then I think that you have a replay at least of the 1970s. Which will be interesting.
Yeah, for sure. Someone else, Jason or Brian, what do you think this is going to, or how much time do you think we have or before it gets real?
Yeah, I don't think we can really predict it. I think the process is something we can have a good feel for, like Rick just said. But every time we've had any kind of a downturn, everybody's become habituated to the fact that the Fed is going to come in and make everything better. And the government is going to come in with fiscal spending to make everything better. When things get really bad is when the public comes to realize that the Fed is powerless and they can't control the situation. The track we're on shows getting to the point where the Fed keeps throwing out more and more liquidity, has to debase the dollar. If we get into a devaluation or a really stiff economic downturn, then the Fed's going to come in and rescue everything. But what happens when the Fed loses control and the market realizes the Fed loses control? Will the market come in and bid interest rates higher? And will the Fed be able to combat that? That's the scenario that's really scary because I don't know what happens at that point. But as far as the timing, I really don't think anybody knows, and I don't think you should believe anybody that says they do know.
Right. Jason, what are your thoughts?
I think the timing is impossible to know. Even the powers that be don't know. But I think it'll just be a slow boiling of a frog, right? Just a whittling away at the value of our savings, our stocks, our bonds, and our freedoms, sadly.
Yeah, for sure. So at this point, we're about the top of the hour. Really appreciate each of you for coming on. In a minute, I'm going to ask you guys to just let people know how they can reach out to you. Before we do that, I just wanted to share about our next event coming up. I mean, Melody, you can drop in the chat box links to this, but if you want to register, this is the next one coming up. We've got a few great multifamily syndicators coming and talk about multifamily investing that came up a little bit in our conversation today. So that's October 27th at 4 p.m. Pacific. So that's going to be a great panel coming up. And then I also recently started a podcast and show on YouTube called The Mailbox Money Show. I'm hoping to get each of our panelists on there one day so we can have some conversations more in detail about their business and what they're doing in regards to this. So you can find there'll be some links in the chat there as well. And I know I don't want to steal Brian's thunder, but the New Orleans Investment Conference is coming up, and there's a little link here to register for that. That's an event I will be at, and I think Brian and Rick are you going to be there, Rick? Are you going to be able to make it out of Canada?
I'm only going to be there virtually, given some political complexities in my life.
Okay, gotcha. Makes sense. Cool. So let's go around real quick and just maybe we can start with Jason, and just how can people get in touch with you or any resources you have for folks?
Sure. So my main podcast is called The Creating Wealth Show. That's been running for about 16 years. I've got almost 2,000 episodes on there. And that's a great way, runs 3 days a week now. So the Creating Wealth podcast, just type my name, Jason Hartman, on any podcast platform. Of course, I'm on YouTube, and then my main website is jasonhartman.com.
Awesome. Thanks, Jason. What about you, Rick? How can people follow you or get in touch with you there?
The easiest way to get in touch with me is Rule Investment Media. I give people an incentive. If you care what I think about your resource portfolio, if you go to my website, ruleinvestmentmedia.com, there's a web form. You can enter your natural resource portfolio. Please, by the way, no cryptos. Please, no pot stocks. Please, no tech stocks. Just stuff I know. I'll rank your resource stocks 1 to 10, no obligation. And I'll comment on individual issues where I think my comments might have value. As an added inducement, I'll include the Barron's Gold Mining Index chart, a 60-year chart, which is the best visual aid for understanding gold bull and bear markets I've ever seen, and a 100-year commodity chart, which will show you visually how cheap commodities are relative to other asset classes going back 100 years. One more time, ruleinvestmentmedia.com.
Awesome. Thank you. I really appreciate you joining today, Rick. Thank you. Brian, how can people follow you, get in touch with you? What's going on in your world there?
Well, they can follow me on Twitter to see my daily views on the world. They can go to goldnewsletter.com and download my investor's guide to gold and silver to learn more about the many ways to invest in that sector. And as you mentioned, my annual investment conference, the oldest investment conference in the world, is coming up October 19th. In addition to Rick and you being there, we're going to have Ron Paul, Jim Grant, Jim Rickards, Danielle DiMartino, Martino Booth, Jim Arurio, Doug Casey, Peter Schiff, Dave Collum, Grant Williams, Abby Costa, George Gammon, Brent Johnson, Peter Bookvar, on and on and on. Dozens and dozens of really the thought leaders, I think, in the markets today. They're going to be there, and it's going to be a blockbuster event. And I encourage everyone to go to neworleansconference.com or the link that you're providing, I believe, to learn more about it and register. Come on down.
Awesome. Well, guys, really appreciate what each of you brought tonight. You guys, played full out here, and I love the perspective and the thoughts. And again, this is not what you're going to hear necessarily on the mainstream, but that's why we love doing these groups, because we're able to really get great folks that can really bring their unique perspective. So I just want to honor each of you for being here. Thank you so much. Also for our investors and members joining, just want to thank you for taking the time to educate yourself. That really is the best investment that you can make. So thank you again to everyone. Thank you to our panelists, and we look forward to seeing everyone at the event next month or at the New Orleans Investment Conference. So everybody have a wonderful night.
Thanks, Bronson.
Thanks, guys.
Bye-bye.